The stock market is an amazing place, but if Willy Wonka and the Chocolate Factory taught me anything about amazing places, it's that the internet has no chill or limit on its creativity. Yeah, and now that I'm kind of thinking about it, I don't know why we made the Willy Wonka reference for options. But basically, the market is a great place for you to make money, whether the market is up, down, or sideways. There is a place for you if you're trying to make money in it. And there's always a but. As many ways as there are to make money, there's twice as many ways for you to lose it. And option trading is no different. There are innumerable strategies when it comes to buying and selling options. You have buying calls, buying puts, cover calls, secure puts, naked calls. Who's getting naked? Vertical spreads, iron condors, vertical straddles, bear put spreads. I need some water. The list goes on. There's so many different ways for you to make money in this market. And of course, each of these strategies has its own pros and cons, and you have to pick the one that is best for you in your trading or investing strategy. I am just here to teach you today about covered calls. Before we get into the video today, make sure you guys hit that like and subscribe button. It really helps grow the channel and the community. We're trying to expand our option trading academy as well as our financial literacy section as well. We're going to kind of venture off into some other content later on down the line, but right now this is our main focus. So if you guys can please help me grow the community by hitting like and subscribe right now. Okay, let's get into the video. Covered calls. That's why you're here, because that's what the status says. There are basically 4 levels of option trading. Each level increases the risk to the trader. So in essence, every level that you go up is kind of like an infinity stone on your gauntlet glove and your Thanos. And the first stone is actually you just applying to be an option trader. And we all know what happens when you collect all the infinity stones and the glove goes on the wrong hand. Level 1 for most brokers are classified as defined risk, which normally means covered calls and cash secured puts, but we're going to just go over covered calls here. Covered calls are pretty simple and not really risky at all. You really don't acquire any more risk than you normally would just by owning a stock. That's why they tend to be the best place to start people off as they become option traders. You actually cannot lose any money on your option. It actually sounds too good to be true. Like I said, this is only level 1. Level 1 is the least risky, and since it's not as risky and doesn't require as much skill, you're not gonna make as much money here, but it still is a good way to get introduced to options. So although covered calls aren't that risky, the premiums tend not to be as high on really good companies. If you're looking for really close dates within like 2 or 3 weeks, the premiums are fairly cheap. So it's not a great way, like we said, to make money, but you can make a decent amount. I actually don't deploy this strategy just because I like to buy the dips and I'd rather not risk selling some of my favorite companies that I own 100 shares of. Let me explain why this is though. Covered calls are actually where the option writer actually holds the shares for the option being written. See, the option holder collects the premium to write the contract. The option holder can thereby provide the physical delivery of the shares if it was to exceed the strike price. Let's look at an example here. Let's say you own 100 shares of lemons. Yes, not Lululemon, but actual physical lemons. You're holding these lemons with the expectation that one day they will actually be worth $100 a share. Pretty expensive for some lemons. You think that I will hit this price within the next 2 years or so? The price of lemons are currently $35 per lemon. Your average position, the price in which you purchase most of your lemons at, is $25 per share. So far, you have made $10 a share on your position. You believe the price in lemons is going to drop within the next few weeks because you heard some pretty bad news and you want to minimize your losses even though you're holding for the long run. You have a few choices here. You can either sell your lemons right now at $35 and hope to then buy them back at a cheaper price in the future, thus acquiring more shares. But by doing this, you risk the price of lemons never dropping and then having to buy back at a higher price. Or you could just do nothing and let the price action of the lemons just take full control. Or you could do one more thing and buy a covered call with a pretty decent strike price within a relatively small amount of time. Let's just say 20% higher than where it's currently trading at. So that would make it $42. When you write a covered call for a stock in which you already own 100 shares of, you immediately collect the premium. Let's just say the premium here for these lemons are about $4. Thus, you have capped off your profit. We know how much you're gonna make off your premium, which is $400, and we know that if the stock goes above or at your strike price, you may be called to exercise your option. So we know how much we could possibly make. Let's look through some of the scenarios though. I'm going to explain to you why you actually can't lose money on your premium, even though you can lose it on your stock, but you won't lose it on your option. Scenario number one, if the underlying stock rises above your strike price, in our case $42 for our lemons, your shares will get called away at expiration. The downside is that the underlying asset rises so far above your strike price that you miss on the increase in stock price past your strike limit. So if the strike price goes all the way up to 55, we have to sell at 42. So we cap off our profits right there at $42 a share. The good news is you do make the money from 35 to 42, but if it does go to 55, you lose out on all that extra money. But you do still collect your premium. So it is still a gain. Win-win, kind of, sort of, maybe. We never really complain when we take profit. So option number one is still in the green. You have to understand that when you trade covered calls, you have to be okay with losing your shares if your strike price actually hits by expiration. You will have to sell at your strike price no matter how high the stock goes. But the good news is your strike price should be high enough to make you some pretty good gains anyway. Scenario number two, if the underlying asset fails to move to the strike price by expiration, your call options will expire worthless, allowing you to collect the full credit on the premium, in our case, the $400. You will keep all your shares and you can sell another covered call on the position later on. That means that even though we set our call price at 42 and we're currently trading at 35, even if it moves to $41, you're still up on both your underlying position and you get to collect the premium. So as long as it doesn't hit your strike price, you're good to go. So at this point, we actually collect the money from the stock going up and we collect the premium because it did not hit the strike price by expiration. The major downside of covered calls is that you are stuck. You cannot sell your shares until expiration. So that means that if your underlying asset does begin to go down, then you have to hold because you have a contract saying that you will give that person 100 shares. And if you don't have 100 shares to give, you're technically not doing a covered call. So you are stuck with your actual underlying asset of your 100 lemons until your expiration date. The good news is you will still collect your full premium if the option does go down, but you do lose value on your underlying asset because they dropped. But it shouldn't affect you anyway because you were planning for the long run, right? We're just trying to minimize our losses because we already know a drop is coming. So it kind of works out anyway for us. We collect a premium, we use that premium to buy more shares after the dip. Covered calls are just a really good trade strategy if you already own 100 shares and you guys expect a dip and you want to just minimize your losses by acquiring the premium and then using that premium to buy more shares on the dip, thus giving you a bigger position and a lower loss because you collected the money for the premium. So if you lose $500 but your premium was 200, then in hindsight you really only lost 3, and then you can use that $200 to buy more shares when it dips. That is covered calls in a nutshell, guys. Let me know down in the comments if you plan on using covered calls on your shares and your long-term investments. Happy trading, guys. Thank you for watching. Hey, if you guys like this video on level 1 option trading for covered calls, then stay tuned because we're going to be having way more videos and we're going to explain every level of option trading. So we're going to be covering all of those infinity stones. So I hope you don't snap your fingers and use them for the wrong reason. But make sure you guys hit the like and subscribe button. Yeah, that's it, guys. I hope you enjoyed the video. This is Breaking Stereos. This is our platform, our community, our voice. Stay tuned. We have a lot of good stuff for you. Happy trading.